Welcome to our finance video tutorial. Today, we'll be diving deep into the concept of the cost of capital. Understanding cost of capital is crucial for both investors and companies as it influences important decisions, from investments to financing. So, what exactly is the cost of capital? In simple terms, the cost of capital is the cost of funds used for financing a business. It's the return rate that a company must earn on its investments to maintain its market value and attract investors. Let's break it down further. The cost of capital comprises two main components, the cost of debt and the cost of equity. Let's start with the cost of debt. The cost of debt is the effective rate that a company pays on its borrowed funds. It's important because it impacts the company's profitability. To calculate the cost of debt, you can use the following formula. Cost of debt after tax equals interest expense asterisk 1 tax rate. For example, if a company has an interest expense of $100,000 and a tax rate of 30%, its after-tax cost of debt would be $100,000 asterisk 1 to 0.30 equals $70,000. Now, let's move on to the cost of equity. The cost of equity represents the return that shareholders require on their investment in the company. The most common method to estimate the cost of equity is the Capital Asset Pricing Model, CAPM. The formula for CAPM is cost of equity equals risk-free rate plus beta asterisk, market return, risk-free rate. To give you an example, let's assume the risk-free rate is 3%. The market return is 8%. And the company's beta is 1.5. The cost of equity would be 3% plus 1.5 asterisk, 8% to 3% equals 10.5%. Both components, the cost of debt and the cost of equity, come together to form the weighted average cost of capital, WACC. The WACC is used widely by companies to evaluate investment opportunities. It represents the average rate of return a company is expected to pay to all its security holders. The formula for WACC is WACC equals E/V asterisk RE plus D/V asterisk RD asterisk 1 TC. In this formula, E is the market value of equity, D is the market value of debt, V is the total market value, equity plus debt, RE is the cost of equity, RD is the cost of debt, and TC is the corporate tax rate. To make this clearer, let's consider an example. Suppose a company has $200,000 in equity and $100,000 in debt. The cost of equity is 10% and the cost of debt is 5%. The corporate tax rate is 30%. The WACC would be WACC equals $200K slash $300K asterisk 10% plus $100K slash $300K asterisk 5% asterisk 1 to 0.30 equals 8.5%. Now that you understand the components and calculation of WACC, let's talk about why it's so important. WACC is critical in capital budgeting. It serves as a hurdle rate that companies must surpass when evaluating potential projects. For instance, if a project generates a return higher than the WACC, the project will add value to the company. Conversely, if the project's return is lower than the WACC, it will reduce the company's value. Let's consider two projects, Project A with an expected return of 9% and Project B with an expected return of 7%. If the WACC is 8.5%, only Project A would be considered acceptable since its return exceeds the WACC. Frequently, companies with lower WACC have a competitive advantage because they can finance projects at a lower cost, which can lead to higher profitability and growth. Let's look at another important aspect, the impact of capital structure on the cost of capital. Capital structure refers to the mix of debt and equity a company uses to finance its operations. A higher portion of debt increases the risk of bankruptcy but also offers the benefit of tax shields. An optimal capital structure is one that minimizes the WACC and maximizes the company's value. Striking the right balance between debt and equity is key to achieving this optimal capital structure. Before we wrap up, let's go through some common questions. First, how does the cost of capital impact investment decisions? Answer: the cost of capital serves as the discount rate in net present value, NPV, calculations, and as a benchmark in internal rate of return, IRR, calculations. It helps determine whether an investment is worthwhile. Question 2. How can companies reduce their cost of capital? Answer: companies can lower their cost of capital by improving credit ratings, maintaining a balanced capital structure, using retained earnings, and optimizing their financial management. Question 3. Is the cost of equity always higher than the cost of debt? Answer: generally, yes. Equity holders take on more risk compared to debt holders and therefore require a higher rate of return. Thank you for joining us today. We hope this tutorial helped you understand the intricacies of the cost of capital. Be sure to like, subscribe, and leave your questions in the comments below.